I need to kind of simplify a little more. Bonds. This is a term I've heard a lot over the years. Like, I kind of know what they are: government bonds, treasury bonds. Can you explain this basic 101, what bonds are and how they work?
Bonds are a securitized way of borrowing money. So, for example, if you want to go borrow money to buy a house, you would go to the bank and get a mortgage.
Yep.
That's really a contract between you and the bank. But if you're IBM or the federal government or Microsoft or someone of that nature, you may find it more prudent to go out to the markets and ask the market for money. So it's a tradable, standardized instrument that has a fixed maturity. I promise I would like to borrow $100 million, and I will pay you back in 5 years, and I will pay you 5% interest on with coupons semi-annually, give you semi-annual payments. And as a result, the market can value that. You can then value, is 5% a good yield based on the credit worthiness of the borrower and based on the prevailing interest rates. If interest rates are 7%, 5% coupon is pretty lousy. Right. And so that bond will have a value less than par. They're usually in $1,000 increments, but everybody always quotes them as percentage of par. So in that circumstance, the 5% bond, let's say it's a very good credit, but if it's 7% prevailing interest rates, that bond is going to trade, I'm just making up a number, 96 cents on the dollar, 92 cents on the dollar. If interest rates are 2 or 3%, well, that bond, people will want that 5% coupon, and the bond will trade above par, by some sort of increment, called 102, 105.
It's like a loan that changes depending on the market.
Well, the terms of the loan don't change, but the market
interest would change.
No, the terms of the loan stay fixed. The amount that there are floating rates, and I'm trying to avoid talking about floating rate debt and all this other stuff. But let's take a plain vanilla, the government bond. The government has huge borrowing needs, and the vast majority of their debt is what's called fixed coupon debt. And so what happens is they do different bond issuances. So we're going to borrow $100 million. So that amount is fixed. We're going to set a maturity, that's fixed. Let's call it 5 years. And we're going to set a coupon. And these government bond auctions go off all the time. They usually get priced somewhere around par, but not exactly. But because, without getting too mathy, there's the present value of cash flows. And what we want to do is figure out, there are equations, and I'm going to ask the listeners to look them up because I really don't feel like getting into them on this, and you don't want me to get into them on this.
Keep it simple, please.
Exactly. And so the bottom line is, if I'm going to give you $1,000 now, or give the government $1,000 now, and get back $1,000 5 years from now, and along the way get 5% a year on the original $1,000, there's a value to that, and that value changes based on interest rates.
Right.
And we're going to use the example of the government because I don't have to worry about credit. If there's a perception that the loan's not going to get paid back, well, then that decreases, all things being equal, that decreases the price of the bond. But so in a very simple sense, it's a publicly traded piece of debt. But the bond markets are very large, very efficient, and you have a lot of people who have the kind of calculators that can price out what the present value of that is. If based on prevailing interest rates now, based on my alternatives, other things that I could do with the money, what is that worth at present? When interest rates were zero, well, people really wanted pretty much anything with a coupon because you couldn't get them. Now, when rates are higher, and depending on when this goes live and when somebody's listening to it, they could be any place because they've been all over the place. But I will guarantee you they're not going to be zero. And so the higher the prevailing interest rate, the lower the value of that coupon, and vice versa. And so that's really what changes it. So in the world of government bonds, there's everybody marking these things to market constantly. It moves regarding interest rates and market forces. But in the case of SIVB, they put it all on these longer term bonds when rates were very low,
Yeah.
when things were not having good coupons. And as a result, when rates went higher, the value of those bonds fell, in some cases fairly sharply,
Yeah, so
even though eventually they'll get paid.